So today we're going to talk about a real estate crash that nobody's watching. So there's a lot going on in this first slide. So obviously some of you may know that that's Chairman Powell, the head and chairman of the Fed. What the Fed's done in their last 10 meetings is raise interest rates. When I look at real estate, I look at the whole picture. So as you can see here on the left side of the slide, you've got your single family. On the right side of the slide, you've got your commercial. But what you need to understand is that they operate very, very differently. So on the left side of the slide, on the residential market, of course, you have very different kind of behavior as a result of interest rate increases. On the right side, you'll see the commercial side, which represents office, retail, industrial, mall, self-storage, all kinds of other things. And even those loans oftentimes are recourse or non-recourse. In other words, they're not like residential. However, the thing in the middle, that's the bank. The bank connects it all. So things that may not be going on in the residential market might be going on in the commercial market. And this video is going to talk about why you need to pay attention to the entire real estate market and not just the niche that you're handling today. So what we're experiencing right now is a debt crisis. We had a debt crisis in 2008. It was about residential. But now we have a debt crisis in 2023 and 24, which is, of course, in commercial. Very different, but it's still a debt crisis, and the banks are square in the middle. As you guys have seen already, we've had multiple banks go down completely out of business, which we're going to talk about in a minute. But the bigger issue, of course, is that many of these banks have 3% loans when today the savings rate is 4%. Doesn't take a mathematician to understand that when you have 3% coming in and you're paying out 4% because deposits are a liability, it's a negative issue for the bank. As you guys know, I love Buckminster Fuller and I love to talk about precession and lag. So a great illustration is when you drop a pebble in the pond and it has ripple effects. And the pebble in the pond, of course, are the 10 interest rate increases from the Fed, affecting everybody very differently. So in February of 2022, some of you know that inflation was almost 8% or 7.9%. The federal funds rate was 0, and the average sales price of a home during this period of time was $514,000, as you can see. So after 10 rate increases, what's changed? Well, inflation has only come down to 5%. And mind you, the Fed actually has a target of 2%. So we've been able to reduce inflation, which is good, from 8% to 5% with 10 increases. But what's interesting, the cost of a single family home is about the same. The Fed has raised rates 10 times, and the federal funds rate is over 5% now, of course, affecting the entire real estate market. But the single-family market actually has not moved that much. It certainly has in specific areas. Some areas are higher, some areas are lower. But if you look at the average sales price, it hasn't moved that much. What has changed a lot is that the interest rates over here made the homes affordable, and the interest rates over here make them very expensive. So what exactly has happened during that 12 to 14-month period? That's what I call lag. So an interest rate increase affects many people immediately, like obviously credit cards or somebody who's buying something today. But for many of us, it shows up over time, and that's what we call lag. So rising interest rates had an immediate impact on residential, but has a lagging impact on commercial. That's why you need to look at these markets very differently. So with residential, banks look at credit scores, but with commercial, they look at net operating income, or NOI, which we talk a lot about on this channel. What's happened with NOI is that the NOI has gone down largely and the cost of debt has gone up, which has driven the value of commercial real estate down significantly, which we're going to talk about in a second. So what happens after 10 increases? Auto sales are down. Real estate sales are down 20%. Inventory is creeping up, but prices for residential haven't really adjusted that much. But commercial real estate values have significantly adjusted, anywhere from 10 to 40% in my estimation. So real estate values are down largely, primarily in the commercial markets. Savings rates are up, but everyone's afraid of the banks. So this is what I call a fork in the road. So as you can see, to the left is residential, to the right is commercial. So right now, facing the commercial market, we got $4.5 trillion in debt maturing that you need to be concerned about. On the same token, prices haven't adjusted that much. However, there are certain markets that are getting clobbered and other markets that are rising like crazy. But the rising rates are keeping people in place because they have trapped equity, and it doesn't make any sense for them to leave their current home and buy another one, because to do that would increase their mortgage and their monthly payment significantly, so they're staying put. So inventory is not growing that much, but days on the market is growing a lot. One of the main things we're going to talk about in this video is that $1.4 trillion of commercial debt is going to mature by the end of 2024. And that's not very long, folks. That's only a year and a half away. So let's first take a look at 2008 and how it compares to 2023. For most of you know, I went through the 2008 crisis. So these numbers are very, very interesting. As you can see, the black line are the cap rates, and the dotted line is the 10-year U.S. Treasury. These are very big markers for the real estate industry. The green represents the spread, which is just the difference between the two. So the 2007-2008 crisis had mostly to do with people actually buying homes that couldn't afford it. They were packaged up, sold off to Wall Street, and everybody bought them. And then when they actually had to pay, they couldn't. And then the entire market collapsed. 2007-2008 was a residential real estate crash. 2023-24 is going to be a commercial real estate crash. So now let's take a look at the 10-year Treasury. As you guys can see, about 2008, it started to go down to zero. During this time, it was basically free money. This is actually what created the asset bubble that we are in today. Then, of course, we had the pandemic and all these other factors that contributed in the disruption that we're starting to see, that's starting to show up as far as inflation and inventory and valuations that are going down. So the rates went down, creating the bubble, and now the rates are going up, deflating the bubble. It's that simple. One thing to pay attention here is that people's dynamics change as well. So as you start to look at office buildings, you start to recognize that work from home and vacancies are starting to creep up, and expenses are also rising. So utilities are up, property taxes are up, insurance is up, all those kinds of things that affect a landlord are also up. While that may not matter to you, you need to understand when occupancy is going down and income's going down and expenses are going up and the cost of debt is also going up, that creates a recipe for disaster. And that's the prediction I'm making, because commercial real estate is in big, big trouble. We're going to go into each category in a minute. This is a very interesting slide, which was done by Moody's, that I thought was very, very good, that I want you to take a look at. There's a lot here, so I'm going to explain it to you. For those of you who have been following the other videos, you understand what NOI is, and that's the most important piece to look at here. So you can see they started with a $10 million NOI and a 5% capitalization rate. What's important for you to understand is that capitalization rates have actually gone up, as have the federal funds rate and interest rates. So now let's take a look at three scenarios. You've got green, yellow, red, obviously like a stoplight. So green means 20% growth, as you can see. Yellow means no rent growth, and red means 20% rent growth. You got to start somewhere, so that's what they've used for this chart, and I think it's very compelling. I can already tell you that rent growth is declining in many areas and across many asset classes right now, specifically in retail and office, and in some cases even multifamily. So every market is going to be a little bit different, but I think this is a good reflection of the different scenarios that could happen in the next 18 months. So now let's first just take a look at the yellow category, which is exactly where we are, because there's certainly no rent growth happening at the moment. With the higher interest rates and the higher capitalization rates, Moody's is already saying that we're at least a 15% decline. And if we have negative rent growth, which is actually happening, we could be up to 40%. As you can see from the narrative here, Moody's is saying that there could be up to a 40% correction in the value of the real estate. What that means is when those assets, loans mature, in other words, when they're up and they're due, The bank is now going to value the property, and they're going to size the loan on today's value as opposed to what it once was worth. In the yellow scenario, you can see it's a $28 million cash infusion, and in the red category, it's a $75 million cash infusion. And I can assure you what that means is that every investor that represents the equity or the LPs, that money is gone on both the yellow and the red. And now, of course, the bank's concerned because now you're eating into the actual loan balance. So the landlords in most cases are not going to fund $28 million to $75 million to keep one deal. They're going to let it go back to the bank because most of these assets have non-recourse debt. In other words, there's not personal guarantees against them. And so they're going to let the banks handle these, and they're going to take these back. This is what I'm concerned about because this scenario exists across multiple asset classes, as we're going to go to in a minute. This chart right here is the outstanding $4.5 trillion in U.S. debt backed by income-producing multifamily and commercial assets. As we go around the clock here, you can see that the top 25 banks actually only hold about 12%. The regional banks, they're a little bit more in trouble, I believe. You got your agency, which is Freddie and Fannie, your life insurance companies, your commercial mortgage-backed securities, your collateralized debt obligations, your CDOs, and then, of course, others. And this is something you should pay attention to because as these loans default, they're going to affect all of these institutions very differently. So now let's get a little more focused. For the next 18 months, 1.4 trillion loan maturities as a percentage of assets by lender. And here you can really see that we've got some exposures in the banking system right there under the depositories, the CMBS, and a little bit under the credit companies and the warehouses. If you take the 1.387 trillion that's represented here and apply the Moody's 15%, you have $208 billion of loans at risk. If you use the 40%, it jumps, of course, over to $500 billion. So now let's get a little bit more detailed. Of course, this is just through 2024. You got multifamily, office, industrial, retail, hotel, healthcare, and other. It totals over there in the far right category, over $700 billion. So the assets to watch are certainly going to be the hotel sector and the office sector because they're the ones suffering from the highest vacancy. Multifamily, of course, is still going to be an issue on anyone that has debt maturing in the next 18 months because for sure their values are definitely less than what they purchased them for just 2 years ago. So all these debt defaults are going to make their way through the banking system, the same bank that makes loans on the residential side. So this slide represents the total direct commercial real estate exposure by asset class. And this is, of course, what we're starting to see today. The reason I wanted to talk about this chart is because the regional, community, and small banks have a significant exposure in the commercial real estate market. As you can see, 16, 24, and 18%, which represents, of course, thousands of banks. This is a tsunami that is coming that has not yet been experienced. And what you've been watching so far has been the bank's exposures as a result of the higher bond costs and people wanting their money and them having to sell those bonds in order to get your money out of the bank. That's what's mostly created a lot of these banking failures so far. This is just the tip of the iceberg. What's important to understand is when the landlords are starting to take a look at their individual assets, as their loan starts to mature, they're going to have to make a decision. And that decision is, do I keep a 50% vacant or say a 25% vacant property, pay in the cash and actually keep the asset, or do I let this go back to the bank? So what's going to happen is many banks are going to take back these assets that are not going to be worth the loan at all. In fact, many are going to be a massive liability to the bank because a 50% vacant building, we're already starting to see sell in areas like Seattle, San Francisco, Chicago, New York, etc. Many of these assets are trading for 25, 30% of what they were just 2 years ago. So the bank's going to be holding on to assets that nobody's going to want. For example, a big 50, 60, 70-story office building, nobody's going to want to buy it at 50% occupancy, especially now we're in a work-from-home environment and those companies are actually requiring less and less office space. And don't forget, that rents are also declining and expenses are also going up. So these assets are going to be toxic. They're going to be on the bank's books for quite some time. until they get priced accordingly and the market corrects. So the question is, what will actually happen to the banks when they get these assets back? So this is what's similar in 2008, because it did happen in residential and, of course, in many multifamily properties. So what happens is the bank actually has to write down this asset, and that further wipes out their equity even more. So this graphic is our 7 ways of a financial crisis, or I'm calling it a debt crisis. As you can see, in 2007, 2008, all 7 of these things happened. I was in the middle of this, and they all progressed at different paces, but they all progressed and they all happened. 2023, we've had 4 of the 7 already happen, and those 4 are as follows. More financial institutions are looking weak. The economic or asset price growth has definitely slowed down. People are definitely running from weak financial institutions as you're starting to see capital move into other type of stronger places. And of course, banks are lending less and people are spending less. What we still have yet to see is a significant economic slowdown, asset prices declining further, which I just predicted, and of course, financial institutions unloading assets into a fire sale, which is exactly what I bought in 2009, 2010, and 2011. They were toxic assets owned by the bank. So of course, I don't want all doom and gloom, so I gave you a list of things that I'm doing personally. So the very first thing is you need to take a look at your asset exposure like the banks. If you don't understand what that means, you need to dig in further. 2, you need to take a look at your asset allocation. If it's heavy in commercial real estate, for example, like the allocations I showed for the banks, you might want to take a look at that and make some adjustments before these defaults. 3, sell off all marginal assets. So anything that's negative or no cash flow. Of course, we don't know where interest rates are headed. Certainly, they're going to be flat for a period of time before they ever get adjusted downward. And when they do get adjusted downward, that's just going to create more inflation, which of course the Fed is still fighting. 4, if you haven't heard me talk about this enough, fix your debt, because it'll hedge the upside if interest rates continue to go up, and you'll always have the opportunity to refinance on the downside. 5, build your cash reserves. Cash is king. My partner Ross and I have actually done some cash-in refinances where we fixed our debt and required a cash infusion to hedge that number, which was just fine with us, and we were able to do it because we had adequate cash reserves. You expect more stimulus money and money debasement. We saw this in 2008 as the government stepped in, or the Fed, to actually backstop some of these banks that could potentially be in trouble as a result of these defaulting loans. 7, please use inflation as your 2023 to 24 strategy, because if you do that, you'll definitely be on the other side of this. What that means is if you have a 2.5 or 3% loan today, that is considered an asset. You're beating inflation as a result of holding on to that asset. Do not sell that property, because that low interest rate loan is definitely an asset today. 8, expect loan defaults due to the commercial real estate exposure. 9, expect bank instability and failures. You're going to see this. What's interesting is that in 2008 and 2009, no one lost their deposits in any of the banks. Some of the bigger banks just gobbled up the smaller banks. So there were hundreds of banks that failed, believe it or not, after 2008 all the way up to 2015. The big banks just gobbled up the small banks, and the depositors were saved during that period of time. These next 3: solve the problem, stay macro, and of course be patient. And I think at least 1 to 2 years, and let this play out. So solve the problem means the bank's going to have a problem with these toxic assets. Be careful that you're not catching a falling knife as they continue to decline in value. But you can still solve a bank's problem by acquiring the assets on their books, because banks are not supposed to own real estate. You are. 2, stay macro. Stop watching the news and try to figure all this out. Just understand that the tsunami is coming, and it will be fixed somehow, one way or another. It'll either be fixed with money, or we'll start to see big devaluations in banks as banks start to take on this toxic debt. And lastly, just be patient. So just expect that these things take time. And at the end of all of this, there's going to be massive, massive opportunity. And that's exactly when you should be diving in and solving some of these problems.